Welcome to our 2026 webinar series, America 250. As we honor our nation's semi-quincentennial, we will focus on securing financial independence for American families. In today's presentation, we will look at key provisions of the One Big Beautiful Bill as it relates to retirement planning and the strategies available for managing longevity risk and tax rate risk. Today's webinar is being recorded and will last about 50 minutes. You must be logged in the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We will answer all questions as best we can. The webinar will be posted to our website within 24 hours. Today we are pleased to present our guest speaker, Catherine Kate Goldsmith. Kate currently serves as Assistant Vice President of Advanced Markets for Western and Southern Financial Group and is a registered representative of W&S Brokerage Services. She holds FINRA Series 7 and 24 securities licenses and is a retirement income certified professional, chartered life underwriter, and chartered financial consultant. Here to present is Kate Goldsmith.
Well, thank you, Valerie, for that introduction, and hello to all. Thank you for taking time out in your afternoon. I don't know where everybody's calling from. I'm on the East Coast here, and we were just talking about the snow that we have. For me, snow is not a four-letter word. I like to ski and I like to skate, but I do so very conservatively. So hopefully you won't see me in a monumental wipeout. But yes, I have been with Western Southern for about 10 years now. Prior to that, I was in-house counsel at Ohio National. And prior to that, I was in private practice. So the only thing I haven't really done so far is work for the government. I don't know, might be in my future. We'll see. But speaking of the government, as Valley mentioned, one of the big things we're going to talk about today is the One Big Beautiful Bill Act, which was signed into law on July 4th, 2025. Now, I have to tell you, I was actually on PTO in Florida celebrating July 4th weekend with some friends who live in that area. And I didn't think that they were going to get it done. I really didn't. Even JD Vance, I'm not sure if he was just trying to under promise and over deliver, but even he said in a press release or a statement that he didn't think they were going to be able to get it done. But all of us will benefit in some way from the provisions of the One Big Beautiful Bill Act. The biggest one being that the tax rates that were lowered by the Tax Cuts and Jobs Act of 2017, effective in 2018, all of those rates were set to expire, along with several other key provisions at the end of 2025. So that's one of the reasons why Congress felt that it was so important to get this done, because all of us, every single person who pays taxes, would have been paying more tax on every dollar of earned income. Earned income is key, right? That's where a lot of the taxes really come into play. But I will go ahead and dive in a minute, but I just wanted to sort of mention why I decided to focus on hedging the longevity bet with a guaranteed income floor. Because even if your client has a lot of money, even people with a lot of money worry about running out of that money. People also have a big tendency to underestimate how long they're going to live. The headlines are screaming about that right now, particularly with the introduction of more GLP drugs being available on the market for a lesser cost. So it's going to be a really interesting next 10 years in terms of this, but I would expect the longevity numbers to continue to increase. So with that said, I would like to ask my colleague, Adam, to advance us to the next slide so we can really kind of get into the nitty gritty here. So again, the One Big Beautiful Bill Act passed in July was definitely a step in the right direction. But as advisors, one of the biggest things we can help our clients manage are retirement risks. And I'll go into how many risks there really are. Then we'll kind of break down a little bit of the tax landscape, some of the highlights of the One Big Beautiful Bill Act, although this isn't really a One Big Beautiful Bill Act discussion. I'm going to move into some other areas. Share with you some sobering retirement statistics. Again, many people have not saved nearly enough for retirement, with a projected need of about 1.2 million in some cases. Many Americans are not even half of that, which brings into question the importance of managing your income in retirement to last as long as you do. So we'll talk about how annuities can be not only a very effective longevity hedge, pretty much the only longevity hedge aside from Social Security. Then we're going to pivot to talk a little bit about wealth transfer, legacy planning, and I'm going to summarize and provide you some available resources that we have available to you through Western Southern Financial Group distributors. I'm actually going to go off camera at this point because I think it's a little strange to watch myself talk, but I will come back on camera later to greet you and to answer any questions. Next slide, please. So again, I mentioned retirement risks. So we have several. We have investment risk, which is probably, any of us who deal with the market know that's a big one that weighs heavily on many retirees' minds and pre-retirees. Concentration risk, that's your classic having all your eggs in one basket. Sequence of returns risk, that is something that certain assets can help mitigate, can't eliminate altogether. In fact, none of the solutions that we have available to share with our clients eliminate risk. Our goal is simply mitigate risk and lessen it as much as we possibly can. Of course, premature death, longevity, which is the one that I'm going to focus on today, chronic illness, tax rate risk. I alluded to that a little bit in talking about how the One Big Beautiful Bill Act came to be. If it wasn't for passage of that, we would all be paying more in tax. Maybe there's even other risks that you can identify that I haven't identified on this slide. But needless to say, there's many different moving parts. In fact, I would say with the One Big Beautiful Bill Act, and I'm happy to answer any questions about this, it's like we just took a chessboard and we made it a heck of a lot more complicated. We actually added chess pieces to the game board, and we're also going to change the order that we would typically move them in playing a game of chess. So that's really what the One Big Beautiful Bill Act, by the way, some people call it OBBA, ABBA. Some people call it OB3. I think OB3 is shorter and cooler. I think it sounds kind of like a Star Wars droid, an OB3, and I'm a Star Wars nerd. So that's what I'm going to choose to use for the remainder of this presentation. So we're going to stick with OB3. But again, OB3 was very helpful in at least helping us manage the tax rate risk part. Next slide, please. Speaking of that, taxes, let's just think about all the different taxes that every dollar of taxable income is exposed to. Of course, federal income tax, state income tax, local income tax, state sales tax, capital gains tax. Of course, we have our FICA Social Security tax that applies to any earnings. You actually pay Social Security tax. You pay tax on your benefits. We know that at the federal level, possibly even at the state level. But you even pay Social Security tax on your benefits. We also have our supplemental 0.9 Medicare tax. I don't even have on here the, oh yeah, I do. Sorry, a little bit of a bullet point error there on my part. But we also have the 3.8% net investment income tax that applies to passive income. We have the alternative minimum tax. I already mentioned Social Security benefits, pension benefits. Congress could completely create a new tax as well. All this to simply paint a picture that the more access our clients have to non-taxable dollars, or at least defer income taxes to when they're in a lower tax bracket, definitely makes sense. Next slide, please. So back to OB3, the individual tax breaks that we are experiencing now. I already alluded to this earlier, but the big thing is the lower tax rates. The other big thing that I would say, especially for your clients who itemize deductions, would be the increase in the $10,000 cap on the state and local income tax deduction. They raised that from 10 to 40. Now, there were some discussions of it being higher, even lower. I think I saw 20, but the law that actually made it across the goal line is at 40,000, which is a big help for states and residents of states that experienced a big increase. When the Tax Cuts and Jobs Act was originally passed, there was some political rumblings about how it unfairly penalized residents in certain states like California, New York, New Jersey, states that had a notoriously high income tax. However, remember, SALT stands for state and local tax. That could be property tax. That could be anything. I sit in Hamilton County, Ohio. our public schools are funded almost exclusively through property tax. So even though the Ohio Supreme Court has ruled that to be unconstitutional, because it does certainly favor some districts over others, that is still how schools are paid for. So anytime a school levy is passed, or anytime they go through a revision, we could see an increase in our property tax, and that's exactly what's happened. You also have private equity firms that have bought up private residences. I think I saw something floated not long ago about the administration's attempt to reduce that, but it's made affordable housing really, really difficult. But this should help not just, again, people who live in high income states, but also people who live in, like, let's say Texas. Again, I apologize. I don't know where all of you are calling in from, but some of these state references may still be helpful. But in Texas, from what I have heard from talking to advisors there, it's exactly what I just alluded to. So Texas may not have an income tax, but they certainly have a property tax, and those continue to increase. In the charitable giving space, there is a new limited, very limited above the line charitable deduction, which simply means that your clients can deduct up to 1,000, possibly two if married and filing jointly, on their taxes. That's going to help out a lot of charities who saw a drop in lower donation amounts from multitudes of people who realize that, gee, I could give to my charity, but now that I can't write it off because the standard deduction is so high, I'm just not going to do it. So the idea here was to increase those kind of lower amounts and give people a break. Now, if you do itemized deductions, then you can take a lot more in charitable deductions, obviously, than that. But there is a brand new floor of 0.5 on any itemized charitable deductions. Now, the big news for higher net worth clients, those who have large estates, one of the other concerns that we've been talking about for several years, to be honest, is the sunset of the exemption amounts. I'm talking about the gift, estate, and generation skipping tax lifetime exemption amounts. They're currently at about $15 million per person. But if it wasn't for OB3, those were set to revert back to the Tax Cuts and Jobs Act era, although indexed, so about $6 to $7 million a person. Again, still not affecting a lot of Americans, but enough higher net worth individuals, business owners in particular, that were a little bit panicky. I mean, not that they were planning to pass away right away. I don't know if any of you have been in business long enough, but you may have been around in 2000 where the exemption amount was zero, but only for 1 year. I don't even want to joke about some of the decisions that families made when it came to family members on life support. But anyway, there it is. But the good news is that those limits have been increased. At least I would say a lot of these increases, by the way, some of these provisions are some are permanent, some are temporary. This one is supposed to be permanent, but you can't see me right now because I took myself off camera. But I would say permanent in air quotes because nothing is really ever permanent. Congress can always pass a law to repeal, amend, whatever the case may be. I do have a question. Let me see. Grateful if the presenter would have personal opinions about the bill out of the session. I respect that. I am telling you not my personal opinions, but literally what was reported in the press. So look at me as the reporter in the situation, but I do respect that. Anyway, one of the other things that the law did was increase the standard deduction. So the standard deduction was already increased by the Tax Cuts and Jobs Act. However, the OB3 increased it across the board for everyone. But with respect to older Americans, those being 65 and over, there is a temporary bonus deduction. So any advisors that are working with clients who appreciate a certain strategy or solution, but maybe you're having trouble finding the money to fund certain solutions, I would say this is a big one. So again, the standard deduction increased very much so for those older Americans. This was part of the whole effort to eliminate tax on Social Security benefits. They couldn't get that across the goal line. So this is sort of like a compromise solution where we're at least going to give a boost to older Americans who may or may not be claiming Social Security. That's what I mean. It's not directly tied to Social Security at all, but that was kind of the goal. The other thing that the law did was introduce a temporary deduction for tips and overtime. Those are limited and again only through 2028. But the good news is that for certain industries, particularly healthcare, first responders that work a lot of overtime hours, the intention here was to essentially shore up, maybe give a little extra incentive for those individuals to work some overtime hours and get a little bit of a tax break for doing so, given some of the shortages in those areas. Anyone who has children, this is good news. The child tax credit was set to be reduced at the end of 2025. It not only didn't sunset, it's been made permanent and it's also been increased. So for advisors working with families, that should be very good news. And remember, that's a credit, not a deduction, so can be enormously helpful. And then finally, there are other people who may have been a little bit nervous about running up to the alternative minimum tax amounts. Those have all been made permanent. The problem with the AMT was that it really wasn't indexed. So more and more Americans were finding themselves subject to it. And that really wasn't the intent of Congress. So in any event, all in all, some good news there. There also were some provisions that were passed to help businesses, particularly manufacturers. I'm not going to talk about those today, but if you have any questions about them, I'm happy to answer those. It's just they're pretty complicated and kind of niche. Aside from one, which is the Section 199A qualified business income deduction, otherwise known as QBI. That also was set to expire at the end of 2025, which would have really led to a really awkward situation because one of the things the Tax Cuts and Jobs Act did as well was make the 21% flat tax rate for C Corps, and they made that permanent. Well, the QBI was essentially passed in order to sort of level the playing field between small businesses, like pass-through businesses, that would be S Corps, LLCs, partnerships, even sole proprietors. All of those individuals have pass-through income. So they are all paying their taxable income at much higher rates than the 21% flat tax rate. Yes, I realize the C Corp has double taxation. That's another nuance involved, but that really was the intention. However, again, QBI, unlike the 21% flat tax rate, was set to expire. But because of OB3, now that provision is made permanent as well. So very helpful for small businesses, which make up the majority of businesses in the United States, particularly, like I said, those pass-through entities. Next slide, please. This just alludes to what I was talking about the increased standard deduction, the found money. You're right, Adam. You're good. You can go on to the next slide, though. Okay, so you'll see here, this is what I was alluding to before. So these are basically pre and post OB3. So you'll see in 2025, so all these rates apply for anybody doing their tax returns right now. So it was retroactive to January 1. So you see a small bump for married filing jointly taxpayers from 30 to 31.5. And then you'll see the single rates, the head of a household. But the real story here, the real takeaway would be that, again, if you have somebody who is 65 and over, as long as their income is below the thresholds shown on the slide, so that would be 75 to 175, or I should say 75 and then 150 for a married couple. That's when it starts, those extra $6,000 starts to phase out. But again, you have to remember a lot of clients who are 65, they may or may not be retired. Maybe they're semi-retired. That's a big choice for some people. So hopefully, their income is below these thresholds. But if it's not, though, if even at age 65, maybe they're still working and they have incomes that exceed these amounts, they're not going to get the extra $6,000. They will, however, still get the extra $1,600 per person for a married couple, or as you see there, $2,000 if the client is single or filing as head of household. So in any event, a lot of extra money to be found. I gave a presentation where Adam was in attendance, so he heard me make this joke before, but I just like to say, go ahead and get this money into some of the solutions we can help them with before they blow the money on something like a hot tub. Nothing against hot tubs. They're great, especially after, skiing or running or something like that. But I would argue we can actually put that money to better use. Again, not knocking hot tubs. I'm a fan. Next slide, please. Okay, so I sometimes are asked, Kate, what's hot? What's hot right now? What are we talking about? I'd say one of them definitely is a Roth conversion. That is a lot of taking into consideration the fact that a lot of clients have amassed a lot of wealth aside from their home in a 401k or an IRA. The problem is that once those withdrawals occur, now they could be pre RMD age, which is right now 73, set to go up to 75 by 2030. But, there are some people who need to take the money, but we don't know what tax rates are going to be. I don't have any knowledge on this. I don't have a magic 8 ball or a crystal ball or anything like that. However, I do think that, and this is a personal opinion, if you don't agree with me, that's fine. Reasonable minds can differ. I personally think that tax rates are going to be higher than what we're experiencing now. There were a lot of pay-fors as a result of OB3, and one of them was we did raise the debt ceiling by $5 trillion. So I do think at some point rates are probably going to be higher, but at the end of the day, we don't know. We don't know. But the reason that IRAs and 401ks can be somewhat risky, assuming it's all pre-tax, is you don't know when you're going to need the money and you don't know what the tax rates are going to be. And moreover, if it's invested in the market, you don't know what the stock market's going to be doing at the time. So having a little bit of flexibility over at least some of your money is, in many experts' opinions, very advisable. So it doesn't mean they have to convert all of their money or move all of their money to a Roth. In some cases, it doesn't make sense. It doesn't, in a low current tax environment like we have now, it might make sense. If you're anticipating future higher income, then it may make sense. Maybe after you sell your business, you become a consultant or something like that, and you're still making a really high income. There's also some planning opportunities for what we call the widower's income tax penalty. What that refers to is simply the fact that, once an individual spouse passes away, you only get to claim the married filing joint rate for the year of death. The very next rate, the survivor, so the widow or the widower, will be in a single tax bracket, assuming they don't remarry. In addition, they're going to go down from the standard deduction rate for a married couple, which I just shared with you, could be $42,000. They're going to go back down to the single standard deduction. So that's what we're talking about. We say the widower's income tax penalty. So the more we can do to reduce their taxable income in retirement, the better. So again, what are we picking up with the conversion? Well, there's no income limits, by the way, to do a Roth conversion. So even though there's income limits that apply to making a Roth contribution in the first place, there are no income limits when it comes to a conversion. You're picking up tax-free growth, tax-free withdrawals whenever you need the money. There's no required minimum distribution period at all. And then also, if you inherit a Roth IRA from someone, there is an RMD. That kind of trips people up sometimes. They think just because it's a Roth and it's tax-free, there is still an RMD. In fact, the Secure Act of 2019 that was passed, as many of you know, severely limited the ability to pass on IRA and 401k money favorably, meaning that most heirs these days are going to be limited to a 10-year withdrawal period. That could come at a time where the person inheriting the money is in a much higher tax bracket. What if the parent is in the 80s and they pass on an IRA to somebody who's in their 50s? Well, that could be their highest working years. And not to look a gift horse in the mouth, but it's still money you didn't have before. But at the same time, if you're the one passing on the money, you'd hope that your heirs would be paying less in taxes. So I guess one way to look at this is, if you are in a lower tax bracket, particularly lower than your heirs, then yes, you're going to have to take the income tax bite in order to do the Roth conversion. But look at this as like shifting money to a lower tax bracket eventually. I'm in a lower tax bracket now. My heirs are in a higher tax bracket. So it can make a lot of sense. Now, once you do a Roth conversion, there's no going back on that. Prior to a change in the law, the Tax Cuts and Jobs Act, which I've referred to several times, you could actually recharacterize a Roth conversion. In other words, you could do the Roth conversion, and then if like the market went down, so now you're paying tax on essentially phantom income, right? Because it's gone down. You could actually change your mind. You can say, never mind, I don't want to do that. I don't want that big tax bill, because you owe it on what you converted, not what it's worth now. Anyway, that's not possible anymore. So it definitely involves a little bit of uh, painting a full picture for the client before deciding to do this. But I do still think it's definitely a hot and smart thing to do. Next slide, please. Oh, this is just alludes to what I mentioned a second ago, which is the fact that recharacterizations are no longer permitted. The other thing that you need to consider is, let's say the client has multiple IRAs. You need to be careful as well, because you can't cherry pick, meaning that you can't take an IRA that maybe hasn't earned as much or maybe even has lost money and decide, well, that's the one I'm going to convert because then I won't owe any income taxes. Unfortunately, Congress was a little bit hip to that. And there is this rule called the pro rata rule, which means that they're going to take all of your IRAs, even ones that you're not converting, figure out what the proportion is of sort of pre-tax money and all that. And that's how the tax bill is paid. It's a little bit complicated beyond the scope of this webinar, but again, happy to answer any questions about that. The only other thing I'd like to note on this topic before moving on is the increased SALT deduction. As I mentioned, the SALT deduction does come with some caveats, including the fact that it starts to phase out. That higher $40,000 limit starts to phase out at about $400,000. I'm sorry, $500,000 of income. So you just need to be a little bit careful. This kind of refers to the chess game that I mentioned. You need to be a little bit careful that, okay, you've moved this chess piece, you pulled the trigger on the Roth conversion, but now you just lost part of your SALT deduction. So you want to make sure that if, as long as the client's under 500,000, significantly under 500,000, no problem. But for anybody who's kind of getting up to that 500,000 mark, you want to make sure that a Roth conversion isn't going to cause them to lose any other deductions to which they would be entitled, especially since this increased SALT deduction, that's also a temporary provision. That's only through the end of 2028. Beginning in 2029, it will revert back to only 10. So again, these are just some of the compromises that were necessary in order to get this law passed. Next slide. But I mentioned the fact that some indicate that you really need to have about 1.2, some surveys even say 1.6 million saved. The sobering statistic here, however, is that 1/3 of workers, and this is from the Employee Benefit Research Institute, they are a very reliable, credible source in the sense that they do this. It's the longest running survey of its kind. I'll just say that. And so this data is pretty easy to find. They do a good job of tracking it. You can locate it. Feel free. It's all public information. Feel free to share it with your clients. But if you look at that, only 1/3 of workers, so these are pre-retirees that they surveyed, have saved, many have saved less than 25,000. 16% said they had less than 1,000. So hopefully you can understand why Congress not only passed Secure 2.0, I think we might even see a bipartisan Secure 3.0 on the horizon, because they recognize that people have done not a great job, frankly, of saving money in many cases. And the statistics just bear that out. So how do you work with somebody who has saved less than 25,000, yet they do believe that they're going to need 1.6 million? If they're young, maybe it's still achievable, but they're probably not on track. Furthermore, only 24% of people surveyed by the Employee Benefit Research Institute said they were very confident about having enough for even basic expenses. Their top concerns that they cited for not having enough money in retirement were inflation, volatility, housing costs, and government benefit cuts. So there is still a lot of concern that Social Security, which is relied upon as a primary source of income by more than 90% of people surveyed in the same group, this whole Employee Benefit Research Institute, if 90% of people say that Social Security is their primary source of income, yet we've already been told many times that starting in 2030, Social Security benefits will start to be cut unless Congress passes another law between now and then to mitigate that. So people are definitely concerned about that. They're also concerned about Medicaid, Medicare cuts in that arena. But anyway, the more that we can do to help them shore up their savings, obviously the better. If your client hasn't started a kind of regular retirement savings program, getting them started may be hard. But I would say that, most clients, once they get accustomed to paying themselves first, it'll be much easier for them to become more disciplined savers. There's a lot of laws that have also been passed or provisions about, an emergency savings fund and things like that. So in any event, that's why we're here. That's why we're having this discussion, and that's where we can help. Next slide, please. This is just more statistics available in that same survey, along with some others, just highlighting the fact that there is still a big gap in the workers' expectations for sources of income in retirement versus the actual sources. So 55% of workers expect a product that offers guaranteed income versus 33% of retirees who say it actually is a source of retirement income. So here you have somebody, over half, saying that they want a product that offers guarantees, yet you have 33% of people who are actually retired who said it is a source of their retirement income. Furthermore, only 25% of workers contributing to an employer plan expect to use savings to purchase such a product. But there is obviously here a disconnect between expectations and realities. So one of the goals, takeaways that I hope you get from the presentation and your moving forward steps is simply that we do have solutions to help them get more guaranteed retirement income. Next slide. So consider the 4 L's in retirement. The first L is longevity. Will the money last? Again, even clients who have a lot of wealth still worry about running out of money. What about lifestyle? Will the lifestyle remain stable? How safe is it? If the individual's riding around in the desert with his or her family on vacation, enjoying a great day, and the individual realizes that they only have a quarter of a tank left and is 180 miles from the next gas station, the joy of the ride does not end when the individual runs out of gas. The joy of the ride ends when the individual thinks he or she might run out of gas. So everybody is concerned about not only will it last, but how safe is it along the way. Legacy. Legacy is not necessarily about the individual's children or favorite charity. It's also about protecting the surviving spouse. So as I already mentioned, when the first spouse dies, there's a loss of a part of Social Security. I'll tell you a little bit about just a brief personal story. My mom didn't understand how Social Security benefits work. I think she understood the fundamentals, but at the end of the day, she didn't realize that when my father passed away, she was able to step up to his benefit, but she lost the spousal benefit, right? You step up, but then you're still losing, say, $800 a month. If you're talking about someone who's on a fixed income, even though one person has passed away, there's certain expenses that stay the same, right? Your property tax, your cable bill, your utilities, all of those remain the same, but on a much lower income amount. So you got perhaps a loss of a pension. Maybe you might have joint and survivor, depending on how the pension's paying out. You may lose a pension. I already mentioned the fact that you've got a shift to the single taxpayer bracket. You have lower tiers for Medicare premium increases and other issues involved. So again, when people talk about legacy, we usually think immediately about children, but we do need to make sure that the surviving spouse is protected. And then finally, liquidity. How prepared is the client for shocks in retirement? Many people surveyed, you can go back to that EBRI data that I shared with you earlier. One of the unexpected financial shocks in retirement could be home repairs, right? Especially if they choose to retire and live out their days within their home. That's all well and good, but again, a lot of them experienced unexpected home repairs or the necessity of buying a car. So again, these are assets that would be discretionarily available upon demand for things that either someone wants or those unexpected events. Next slide, please. Now, some people might think if volatility is a concern, I'll just work longer if the market drops. But again, along the lines of sobering statistics, there is a large gap between when we think we're going to retire versus when we actually do. Most retirees stop working earlier than planned. Chronic conditions impact 75 to 90% of older adults. In fact, 90% of adults 65 and over have at least one chronic condition, and 75% age 35 to 64. And then if they're 65 and over, about 80% have two or more chronic conditions. Now, these might not be conditions that don't allow them to continue working, but it may be that they cannot work the same schedule, or they're going to have to work a reduced schedule. And then finally, a 20-year-old worker, someone, I don't know about you, I have a 22-year-old daughter and a 24-year-old son, and no, they don't think that they're invincible. But even thinking back to when I was 20 years old, you don't think about the fact that 1 in 4 people have a chance of becoming disabled before they even reach Social Security's full retirement age of 67 if you were born after 1960. So again, just some backdrop. Not trying to scare people, but I'm just trying to create a very realistic backdrop for individuals. Let's present our clients with a solution they can put into place now that helps them avoid the sequence of returns predicament by providing access to another source of income with even built-in chronic illness protection to help mitigate some of these risks that I talked about earlier, including chronic illness. Next slide, please. So you'll see this is kind of more of the intangible aspects, not so much the hardcore dollars. But a lot of times what we're talking about when we're mitigating all of these various risks that we've outlined today is retirement happiness. It's the classic being able to sleep at night. If you talk to retirees, one thing they miss the most is a paycheck. Yes, they get that in the form of a Social Security benefit, but we have a lot of solutions and strategies available that can also help them receive a paycheck. Living too long is one of the key stresses on financial security. It has been suggested that guaranteeing income helps mitigate a variety of risks that we are exposed to as we get older. One of the various designations, letters behind my name, is the RICP that Valley mentioned. That's the Retirement Income Certified Professional designation. If anybody's interested, I definitely would recommend it. It's 3 courses, but it's really, really great material. And that's what I drew from actually in part of the presentation here. So guaranteed income helps mitigate things like frailty or even cognitive decline. It's like a direct deposit. We can set up some of their annuity payments, for example, to be a direct deposit. So that's also not only addressing the paycheck, but also the idea that the money is going to be there. They don't have to go cash a check. Frankly, in some instances, you can avoid elder abuse vulnerability. It's extremely distressing to read stories about that, yet they do happen. If money is locked up into a SPIA, for example, and somebody needs money from the individual, as in many cases, a SPIA cannot be commuted. It's providing that guaranteed income floor, but you cannot commute it to a large sum. So it's just the monthly income and not a huge lump sum. I've had cases like that come up in my former life when I was in-house counsel, where people would try to get big access to money because their son or their daughter or whoever, maybe even a caregiver, needed money and they wanted to provide it, but for better or worse, it was locked up. So they still got their guaranteed income, but didn't have this large sum of money that they could then give to a relative, whether or not it made sense or not. Excess withdrawal risk. One of the big issues that the retirement income certified professional coursework covered as well is, how much do I withdraw? Do I do the 4% rule, the 6% rule? Having guaranteed income also helps eliminate the excess withdrawal risk. So a safety first income floor improves emotional well-being. So this is what I meant, sort of like the intangible part of all of this. Secrets to a happy retirement. It's not just the party when you retire and, of course, vacation. It's the guaranteed income. That's a big one. I don't know if you've ever seen Jerry Maguire, but if you remember at one point, he says to Cuba Gooding's character, help me help you. So that's how I look at this as well. Also, one cannot mitigate any longevity risk with a stock, bond, mutual fund, or even a real estate investment trust. Only an annuity guarantee can mitigate longevity risk alongside Social Security. That's very powerful. Next slide, please. I do see that I have several slides left, and I see we don't have that much time. So I will apologize in advance for moving through some of these a little bit more quickly than others. I think a lot of this is pretty self-evident as well. Obviously, the longer that you live, the more exposure you're going to have to inflation and healthcare costs. And so security alone is insufficient for many. But as I already mentioned, longevity risk can only be addressed by having a higher percentage of income guaranteed for life. Ideally, with a cost of living increase, there is no commercially available annuity that has a exact COLA. It's just too hard to price. So security is the only true income source that has a true COLA attached to it. But you can do things like add an increased purchase option that can help try to keep pace with inflation. Next slide, please. Okay, this is actually pretty powerful. So if you think about it, I already indicated that most people underestimate how long they're going to live. Consider this. Look at my source. A healthy 65-year-old married couple has at least a 50% chance that at least one is going to live to age 93. So it's only a 50% chance. And I'm not a big gambler unless I'm gambling with somebody else's money. But at the same time, 50-50 is not bad for age 93. So have they built a portfolio to last to age 93? Next slide, please. Okay, not as long, not 93, but here we go with the odds again, right? There's an 80% probability at age 65 of living to a specific age. For men, it's about 83, and for women, it's about 86. And whenever you're talking about whether it's your own needs, having enough money to last your lifetime, or if it's a question of leaving money to your heirs, a simple question is, do you want to leave your heirs more or less? Hopefully, everybody says more. And once they do, then we can come in and show them how we can leave heirs more by paying less in taxes. Next slide. So annuities help guarantee income lasts as long as you do. Again, I already referenced this. Only annuities provide commercially guaranteed lifetime income, and they take different forms. So, of course, you could have a SPIA that starts paying income immediately, or you could defer the income later, but it's still guaranteed. You're going to get that. That's that paycheck in retirement. If you have qualified funds, you can also set up a QLAC, a qualified longevity annuity contract. I believe the amount is 210,000. Don't quote me on that, but yeah, it's 210,000. We have a tax reference guide, by the way, that we could send you that's client facing. That's really helpful. But in any event, 210,000. So let's say the client's sitting on a $500,000 IRA that they've already told you, I'm not going to need to access this money at 73. What can I do? Well, at least for 210,000 of that, they could put that into a qualified longevity annuity contract whereby they can push those RMDs out until at least 85. Clients like having flexibility and like having choices, options. The RMD gives you no option, no choice. You have to take the money starting at a certain age unless you put it into a vehicle like a QLAC. I just talked to an advisor today that really wanted to know more about it and asked me why more people weren't buying them. I don't have any intel on that, but it was a great kind of rhetorical question. And we do have some flexible settlement options as well in the various products that the industry sells for legacy planning. And as I already mentioned, no, we don't have a pure COLA, but we do have the IPO that may at least help keep pace with inflation. Next slide, please. So some people incorporate a bond ladder, and I'm not here to knock bond ladders. I think they're great for providing that predictable income. Just recognize that it does not provide any longevity protection. So flooring with an income annuity can remove the longevity risk. They're transferring that risk to the insurance company. It may allow a little bit more aggressive investing than elsewhere. And also, I didn't mention this before, but with a SPIA, you actually have tax favored income and that you're getting the exclusion ratio. So, assuming we're talking about not all pre-tax money like a QLAC, but after tax money, every portion, every payment the client receives is going to be part return of basis, part part interest gain. So it can by paying less in taxes along the way, you can expand the lifetime of that money with no additional fee drag. So some pretty nice benefits there as well. Next slide. So in the interest of time, I'm only going to have two messages for this. First of all, our country is about to undergo the largest wealth transfer that this country has ever seen. About 84 trillion, depending on the study that you read, is expected to pass to the next generations. I'm going to flip all the way down to the last slide, which is that women are expected to control $30 trillion by 2030. That's only a few years from now. Just take note of that, in the sense that, you know, some of your clients, if you're not already working with women in particular in your client group or client base, I would definitely at least touch base. And then finally, next slide. I just want to present something to you because a lot of people, in fact, I have an ask for you. If you have a book of business and you experience this, I hope this resonates. Basically, if you have one spouse that dies and leaves money to the surviving spouse in a trust, let's say they had a revocable trust that becomes irrevocable upon death, there's a lot of cash in that trust, maybe even some real estate. Well, here's an interesting idea. Instead of the trust purchasing a $1 million annuity, which is tax deferred, right? So no income producing assets in the trust, it's going to generate income tax at the higher trust rates. So the tax deferred, great idea. Maybe you do a $1 million annuity on mom. It's not a horrible idea. However, at mom's death or dad's death, whoever is the survivor, 50% of that death benefit is going to be distributed to their one child. This assume the client has told you they have some legacy goals here. All right, the other 50, of course, is going to pass to the other child. What if, however, we take that same $1 million that the client has already indicated to you that they intend to pass on to their children? Well, just by purchasing two $500,000 annuities, still earmarked for the same people, only instead of mom being named the annuitant or dad, we're going to name the actual child, because of a very favorable provision in the tax code and interpretations of that code section. The trustee can actually distribute the annuity contract to the annuitant at mom or dad's death. At that point, the child, there's no immediate taxation. They can continue the deferral and name their own beneficiary, and now they already own their contract. So really, really powerful. Again, you're giving the client options as opposed to putting them in a situation where they not only have to take the death benefit, but now they have to take the money all out within 5 years. So I actually took this picture from a piece that we have on this. So if that resonates with any of you, let me know. It's just that once you name the annuitant, you generally can't change the annuitant. So that was the reason for the ask. That's what I'm saying. Make sure you get a hold of this before it's too late, because once they buy the annuity with just mom, then they won't be able to take advantage of this strategy. Next slide. Again, just kind of more of the same. We do have with Western Southern, we have a product. It's the Income Source product. It's our single premium immediate annuity. We also have different pieces that can show you how you can even incorporate this, not just with parents and children, but with grandparents and grandchildren as joint annuitants that will let you pass on a guaranteed annual income stream, not only for your life, your child's life, but even your grandchild's life. And we, again, have some pretty powerful pieces that can show you how you can turn one single premium into payments for several lives. Next slide. It's going to be really difficult for you to see this, but this is the piece that I'm alluding to, where again, you're creating a future income to last generations. What a great gift. Next slide. And if you don't want to go the SPIA route, at least you have the tax deferred annuity, not taxed until withdrawn. Look at the 1040. See if you see CD interest income. Ask them what they're doing with that CD, that interest income that you see there on the 1040. Maybe they're just letting it roll over, mature. But maybe that money has already been earmarked for heirs. Well, how about an investment like a tax deferred annuity with some of that CD money where they don't get the 1099 every year? It's not taxed until it's withdrawn. And even if they are using it for life, at least while it's in the deferral stage, they can actually potentially reduce their tax and Social Security. And this is, we're well situated for the current market. In 2020, there's about $219 billion. This comes from LIMRA of annuity sales in the United States. That number grew to 424 billion just 4 years later. So we got a really great story to tell. These products support asset repositioning in the manner I just alluded to with the CD income, as well as tax efficient legacy planning in several of the pieces that I mentioned to you. So I am going to couple more slides, but I'm officially going to shut up. And that way you guys can have an opportunity, if you'd like, to posit any questions. If not, Adam knows how to get a hold of me. Valley knows how to get a hold of me. But again, there's a lot of things that you can accomplish. Go back one slide, Adam. So again, you're not going to be able to see this either, but this is just a really nice guide where you can take the client's 1040 and just walk through like line by line and say, okay, what's happening here? Okay, tell me about this. Tell me more about this. Would you like to have more of this? Would you like to have less of that? It's a really nice guide. And then we have, so that's client facing, but the piece on the right is actually designed for you, where it can go into more detail than the key that I show on the left. So that's it. That's all for me. Any questions? Thank you again for your time.